There is an entire content industry built on teaching you to trade options. The influencers have the setups, the strategies, the Discord servers, the six-figure screenshots. The implication is clear: options trading is how real investors make real money, fast. The data says something different. And the data doesn't care about the screenshots. Let's start with the numbers. Not anecdotes. Numbers. According to SEC data on options market activity, approximately 70% of all options contracts expire worthless. Worthless. The buyer paid a premium money that is now gone and received nothing in return. This is not a market efficiency argument. This is the base rate for options buyers. Most of the time, you lose everything you put in. Now someone is going to say, what about options sellers? If buyers lose, sellers win. That's mathematically correct in the abstract. But retail traders are almost never structured as disciplined sellers. They're buyers, chasing leverage and lottery ticket returns. The CBOE, the Chicago Board Options Exchange, the institution that actually runs the options market, has published research on retail options trading performance. The finding: retail options traders underperform a simple buy and hold index fund strategy by 3.8 percentage points annually. 3.8% a year sounds small. It is not small. At $100,000 invested, that gap compounds to over $200,000 in lost wealth over 20 years. Relative to just buying the S&P 500 and doing nothing. To be clear, retail options traders don't just underperform. They underperform while taking on dramatically more risk, spending significantly more time and emotional energy, and paying substantially higher transaction costs. On every dimension: risk, time, cost, return, the data says, this is not worth it. To understand why retail traders lose, you have to understand who is on the other side of the trade. When you buy an options contract, you're not buying it from another retail investor. You're buying it from a market maker. Market makers are professional trading firms, organizations like Citadel Securities, Susquehanna International Group, Virtu Financial, whose entire business is providing liquidity in options markets and capturing the spread between the price buyers pay and the price sellers receive. This is called the bid-ask spread. On a liquid stock option, the bid-ask spread might be 5 cents. On a less liquid option, it can be 50 cents or more. Every time you enter and exit an options position, you lose the spread. That is a transaction tax that the market maker collects on every single trade. You are on the wrong side of this tax every time. But the spread is just the beginning. Market makers use a practice called gamma scalping to hedge their exposure and capture additional profit. Gamma is the rate of change of an options delta, its sensitivity to price movements in the underlying stock. Market makers who sell you options dynamically hedge their books using the underlying shares, buying and selling as the stock moves to remain neutral. This is a sophisticated, automated process they execute at scale. You are not competing with another trader who has the same information you do. You are competing with a computer system running hedging algorithms, backed by decades of institutional expertise. The structural advantage market makers have over retail traders is not a matter of skill. It is baked into the architecture of the market itself. The retail trader cannot access the same pricing data, cannot execute at the same speed, cannot absorb the same losses when positions move against them. This is not a level playing field. And knowing the rules of a game you can't win doesn't make you more likely to win it. Here is the argument options proponents always make: yes, it's hard at first, but once you learn, you can be consistently profitable. The learning curve is real, but it's worth it. There are two problems with this argument. Problem 1, the learning curve is paid in real money. You don't practice options trading on a simulator and then go live. Or rather, some people do, and then discover that paper trading produces completely different psychological conditions than real trading. The anxiety, the temptation to overtrade, the emotional response to a position moving against you, none of that is present in simulation. The learning curve that costs real money is the one that matters. And that learning curve costs most retail traders thousands of dollars before they either quit or develop enough discipline to stop losing. Problem 2. Even after the learning curve, the structural disadvantage remains. The market makers don't get less sophisticated as you get more experienced. The bid-ask spread doesn't narrow for you because you've traded for 2 years. The options still expire worthless 70% of the time. You've just paid expensive tuition for a degree that doesn't change the underlying math. A 2018 academic study published in the Journal of Financial Economics analyzed the accounts of retail options traders over a multi-year period. The finding was stark. Even controlling for skill development over time, retail options traders continued to underperform passive investing. The experience didn't close the gap. It just made experienced losers out of inexperienced ones. The question is not whether anyone makes money in options. The question is who, and under what conditions. 3 groups actually profit from options markets in a sustainable, structural way. Group 1, market makers. We covered this. They collect the spread on every transaction. Their edge is structural, not informational. Group 2, institutional investors using options as insurance. A fund managing $2 billion in S&P 500 exposure buys put options to hedge against a significant market decline. They are not trying to profit from the options. They are paying a premium, like an insurance premium, to protect against catastrophic loss. This is rational risk management at scale. The options are a cost of doing business, not a profit center. Group 3, disciplined covered call writers. This is the one legitimate options strategy where a retail investor can generate additional income without taking on excessive risk and only under specific conditions. A covered call involves selling someone else the right to buy shares you already own at a predetermined price. If you own 100 shares of a stock and you sell a call option at a price above the current market, you collect the premium up front. If the stock doesn't reach that price, you keep the premium and your shares. If it does, you sell your shares at the agreed price, which is typically still a gain. The key word here is covered. You already own the shares. You're generating income from an asset you hold. You're not using leverage. You're not betting on direction. This is a fundamentally different activity than buying options for speculative gain. There is one more situation where options make sense for retail investors: buying put options as insurance on a concentrated position. Say you work at a company and you've accumulated $300,000 in company stock through your compensation plan. That's a concentrated, undiversified position, a known risk. You can't sell it immediately because of tax consequences, or vesting schedules, or other constraints. Buying a put option on that stock, paying a premium for the right to sell it at a set price, functions as insurance. If the stock drops 40%, your put option gains value and limits your loss. You paid a premium, the way you'd pay for homeowners insurance, knowing you might not need it. This is not a trading strategy. It is risk management. The goal is not profit. The goal is protection. And that is the correct lens for retail investors to use when thinking about options at all. Outside of covered calls on shares you own, and protective puts on concentrated positions you already hold, options are not a tool for retail wealth building. They are a transfer mechanism, moving money from retail traders to market makers. You need to understand the business model of every options trading influencer you've ever watched. They are not rich from trading. Some were never consistently profitable traders. The product is not their trading strategy. The product is the course, the Discord, the newsletter, the affiliate commission from the brokerage that pays them for every new account opened. The screenshots are real, they represent their best trades, carefully selected, not their average returns. Every active trader has a great trade. Nobody screenshots their account when it's down 40%. The incentive structure is important. An options trading influencer makes money when you sign up, when you subscribe, when you open an account through their link, and when you stay engaged with their content. Whether or not you make money trading is irrelevant to their revenue model. Your success or failure does not affect their income. Your engagement does. This is not a conspiracy. It is just economics. But it creates a massive conflict of interest that you should factor into every piece of options education content you consume online. The wealth building path is not exciting. Buy index funds. Hold for decades. Don't trade. The channels built on that advice have smaller audiences because it's boring. But boring beats complicated and wrong every single time. 70% of options expire worthless. Retail options traders underperform buy and hold by 3.8% annually. Market makers win structurally, not by luck. And the people selling you options education are not in the options business, they're in the education business. Now you know. Word count, 1 320 duration, 10-minute end card, V47, from $100,000 to $500,000, the 5-year wealth acceleration plan.